When we think about the outlook for the global economy in the coming year, I think the story that we've been witnessing over the last 12 months is going to be a bit more of the same, a very solid growth in the countries with large demographics. Think China, India, Brazil. These will continue to be the engines of growth economically for years to come.
Growth rates might bounce around a little bit, but in effect we think that we will continue to see high single digits growth rates in these countries, perhaps at the lower end for Brazil and at the higher end for China.
Secondly, countries that have lagged in private consumption historically. We will see, for instance, strong growth in several African countries, and many companies are starting to take notice of that, in fact, and position themselves in Africa.
The next set of economies that are dependent on these economies for growth are the resource-rich economies, such as Australia, the Middle East, Russia, who will also see good growth rates as commodities reflate and continue to fuel economic growth in places like China and India. Beyond that, in the developed world, we actually see very strong signs of life in America, where we are seeing companies across the board acting decisively, acting strategically, making investments, and driving quite impressive growth.
The US has been quite encouraging, and we're going to see a stronger US in the coming year, and that has been the story, frankly, over the last 6 or 9 months.
The picture for Europe is somewhat more mixed. What we see here is Germany really stepping up as an engine of growth, not only in Europe but in the world, with its extremely strong manufacturing capabilities, supplying the great appetite for capital goods and for engineering products in developing countries. The other important feature, of course, in Europe is the performance of the periphery countries, which continue to be of concern. I think that sovereign debt will be problematic in various ways, will require interventions in a number of the periphery countries, where, of course, the greatest concerns should be focused on the stability of Spain. Apart from that, the UK is showing signs of life, perhaps demonstrating that fiscal prudence can be combined with economic growth in what is perhaps the most bold experiment in controlling financial deficits and fiscal deficits in the government level in a really quite decisive way. So overall, Europe will continue to be a bit of a mixed picture, with some economies doing quite well and others struggling under the burden of debt that has been accumulated over the last 10 years.
Organizations develop resilience first by understanding the risk that they incur themselves. So, what better way to be resilient than to know exactly what kind of strategies you're embarking on, what kind of risks you're taking, where are the areas where you need to be watchful.
It is fairly clear that there are a couple of major forces driving the way major companies, particularly global companies, need to be thinking about the world. First, I think that global portfolios of businesses are really important, especially given the patchy picture of growth that we see around the world. So for European and North American companies in particular, finding ways to participate in the arc of growth in the major economies in terms of drivers of growth in the world will be quite important.
The second way for companies or organizations to build resilience is really to be coherent in what they do, in how they develop products, in how they play in certain markets, in how they try to attract and build their customers, and being coherent across businesses, across products.
The most important way in which to acquire resilience, in our view, is to focus on what companies are really good at doing, what we call capabilities-driven strategy. By this we mean that we think that companies that are coherent in terms of understanding how particularly they add customer value, the capability systems that they build in order to sustain that basic customer promise, coupled with consistent and coherent products and services, are the ones that win. And never has this been more important than today. In terms of the role of businesses in developing countries, there is an overriding issue, which is that in spite of impressive economic growth in a number of these countries, there continue to be pressing social issues.
If you think about what businesses need in any country, they need a well-educated workforce, they need a productive workforce, and they need a healthy workforce. And so I think businesses in developing countries will be a great engine of soft pressure on governments to provide these things.
The social infrastructure of these countries is good for business, and business plays an important role and will continue to play an important role, not just in furthering shareholder value, but also in improving the environment in which they operate.
Increasingly, European and North American companies have to build positions in the large emerging economies. And the way for them to build sustainability and participate in this arc of growth, as we call it, is to really demonstrate that they understand the lay of the land in those countries and be part of the social and economic fabric of those countries, i.e. demonstrate a commitment to those countries for the long term, i.e. not just coming to try to make a quick buck.
Because frankly, long-run sustainability for multinationals operating in the high-growth economies will depend on them being seen as genuine partners in economic development and not just companies that seek to exploit growth opportunities in these environments.
Our world has undoubtedly become much more interdependent over the last decades, and with this comes the need for countries to adopt similar norms around, for instance, sound governance. Whether it is in the private sector or whether it is in the public sector, sound governance has become paramount, and the lack of sound governance in one major economy can wreak havoc on the economies of various other countries.
The most important norm that we need to be concerned with is to align the short and the long run concerns of institutions with the overriding objective of stability. What we see in this crisis is that globalization has been very good for millions of people around the world. On balance, in spite of the distortions that globalization has created, it has driven tremendous growth around the world. But what we also see in this crisis is that globalization has created great interdependencies across economies. And so the very forces that have led to tremendous economic well-being for many people are also the ones that can bring the entire system down with profound consequences, again, for the same millions of people who were affected positively.
Having sound regulatory institutions that endure and serve the greater good also will lessen the global risk from an economic standpoint. And let's remember that any institution, whether it's public or private, we've seen it with banks, for instance, in the last few years, that does not play or does not adhere to those norms poses an incredible amount of risk on the global economy.
It is insufficient to merely consider what is good in the short run for shareholders. Indeed, one might argue that the purposes of systemic stability and of institutional longevity are in fact one and the same.